Welcome to this week's Trade of the Week. My name is Joshua Bellinger of OptionSizzle.com. We're taking a look here at Freeport-McMoRan. Now, I'm going to walk you through some of the analysis that led me to this FCX trade that I'm going to walk you through. One of the things that's going on right now, if we take a look at the FXI chart, which is the iShares China large ETF, we notice that on this chart here, you could see to the right that it's not looking so good. And there's some issues with China going on right now, and the market's seen some liquidation, and that overall has implied volatility, or the overall volatility in the marketplace, a lot higher. For those that look to sell options, this is where opportunity exists. Now, those would look at this and say, there is no way in hell I'm going to be selling some options in this, Josh. The market could go to 0 or it could go back to 52. Well, we have to look at probabilities. And for this trade specifically, we're going to look at something just on a little bit of a lateral to kind of offset a little bit of that risk. So if we don't want to go with the iShares China ETF, what we can do is look for some alternatives that are kind of tied into that market. So the first thing, what would be tied to that market? Well, copper. Those that are not familiar, copper is tied to China big time. And with that, what we can do is we can look at something similar to that. So what came up that provides a lot of liquidity and also at the same time provides a low-priced underlying, which would fit into a lot of accounts, would be this FCX. So if we take a look here at FCX, it's a little bit on its butt or near its low of the chart here. And I'm a little bit sick, so doing this, I'm trying to get the video out, so I'm a little slow on my thought. But right here, we hit a low of 16 today. But overall, when we look here at some of these IV stats, and you might not be familiar with this, but overall right now, we have some decent implied volatility. So if we take a look here at the overall chart and we look at the current IV percentile here on Thinkorswim, it's right here at 75. Now, just to show you the difference, and it's not something that you can compare exactly, but I just want to show you the difference in the current IV. So here is at 90, and we have FCX that's at 75. So this provides an opportunity typically when we look at something that is above that 56 or 50 to 60 IV percentile, meaning that it's comparing itself from before and it's showing that the options or the overall implied volatility has increased and it is near its top of the range. We can look for some opportunities here. So one of the things that we would take a look at, and those that are not so active would be looking at a timetable of about 45 days. And the reason why 45 days is because gamma is not as aggressive as when you get into the weeklies. Everyone wants to trade weeklies, but the fact is that the gamma on these weeklies are going to be so tough that for a lot of trades and a lot of traders, the 45-day window, 45 days to, if we had something into about 60 days, that would be an ideal time frame. And the reason why is because that's where the decay starts to really increase. So we want to be a seller of options. So where is the strategy at this point? Right now, what we take a look at, or what I'm looking at here, is that we have a price point of $17. That opens up a lot of opportunities with what strategy to do. Are we going to do risk defined, or are we going to do undefined? On this one, I would say I want to do undefined. And there's a couple different reasons. The first one I said, prices are low. And also, we have implied volatility at a decent level here. So for this, this provides a good amount of opportunity to allow us to put something on, and also at the same time, look for the opportunity to put something and add to that position. So if implied volatility goes higher, we want to add to that position. So one, and my first thought was to sell the straddle at this price point. So if we say the 17, we have a 25 cents of some intrinsic value there. And right here, we take in about $2.14. If we look here, we have about $2.43 where a one standard deviation move to the in the next 45 days is going to be the range high and low. Now, the other thought I had on here was, well, let's take a look at something else where if you were thinking of this as being too aggressive. So we have a $2.14 cushion, and what we're looking for this to do is implied volatility to kind of drop out and also kind of hang out at this 17 level. If it doesn't, we have a break-even point of about $15 and then $21 to the upside, give or take. Now from there, that gives us a window and a range. And one other opportunity that you could look at for this would be to sell a strangle. Now on this $2.14, we wouldn't look to take in this whole $2.14. On a position like this, because we're taking in so much credit, what we're looking for is it just to kind of suck out of there pretty quickly and to really manage this pretty early. Now, if we go with something like a strangle where we sell, for instance, the 19, and what we can do here is we can just sell the strangle here. So the 19 call, and I would look at the 17 put. So if we notice here, this 19 call has about 40 cents on the ask price here. If we go to the 17 strike here, which is just about, or 17's at where prices are trading at now. So we want to go just about $2 lower than that. So what we would go to is probably about the 15. We could look at the 15 and a half, but even at the 15, you could see here that we have about the difference in here as well. So we have a mid price of about 37 cents. And on the calls here, we have the mid price of about 38 cents if we're looking to get a fill right here. It would tighten up when the market's open here. But overall, you'd take in a 75-cent credit. Now, this would give you different break evens. We would give you 75 cents to the downside extra here and also to the upside, which could give you more cushion. And at the same time, give you a little bit more wiggle room to let this trade play out. Again, 75 cents on a $17 stock and you trade one option, you're looking at a relatively decent return on investment. And these are just going with using margin and a margin account. You can do that. Now, if you want to look at something different, you could look to sell the iron condor, but with a price of a underlying at $17, I think the best opportunity is either going to go with a straddle and or go with a strangle here to make it really simple and also easy to manage as well. And that's kind of the key thing I would look at this and what I would be looking at going into tomorrow for a position for myself. I'm looking at this as, okay, if there is some uncertainty, if there is some more volatility that comes into play and I want to take advantage of that, the best way to do that is not to have defined trades because that makes things a lot harder. I've already maximized my loss on there. What I want to be able to do is undefine that and be able to roll kind of with the punches here and be able to take advantage of those opportunities. When you have more than two legs for a position, things get really complicated. So two options that you have here, instead of going with the FXI, you can look at the FCX here because it has copper tied into it and you also have some gold, but you can look at this and you can look at the strangle and or the straddle. And that is my trade of the week.